The Super Bowl. It's more than a game, it's an event that brings people together from all walks of life, and increasingly, it's a massive gambling opportunity that attracts millions. Super Bowl 59 saw over $1.5 billion wagered, a staggering amount. That's a 15% jump from the year before, showing no signs of slowing down. The entire 2025 football season is projected to rake in $35 billion in legal bets, an unprecedented figure. The total sports gambling market, a staggering $150 billion a year, encompassing all forms of sports betting. This explosion in sports betting mirrors another phenomenon, the rise of the retail investor, both driven by technology and accessibility. Both groups, it turns out, share a surprising number of psychological traits, including risk-taking and the thrill of potential rewards. These aren't just harmless pastimes, they can have significant financial and emotional impacts. They represent a fascinating intersection of psychology, finance, and risk, offering a unique lens to study human behavior. By understanding the motivations and biases of both investors and gamblers, we can gain valuable insights into our own decision-making processes, potentially leading to better outcomes. Investors and gamblers might seem worlds apart. One deals with stocks and bonds, navigating the complexities of the financial markets. The other with cards and roulette wheels, trying their luck in the world of gambling. But beneath the surface lies a shared delusion, overconfidence, a trait that blinds both to the risks they face. Both groups consistently overestimate their chances of success, driven by a false sense of certainty. A recent study found that sports bettors, despite consistently losing an average of 7.5 cents per dollar wagered, still expect to break even, showcasing their misplaced confidence. This mirrors investor behavior perfectly, where losses are often rationalized away. Many investors chase risky high-return investments, ignoring the evidence that favors a more diversified long-term approach, often to their detriment. They behave as if they have an edge, just like the gambler convinced their system will lead them to riches, despite the odds. The truth is, both groups often fall prey to the illusion of control, believing skill can overcome odds stacked against them, when in reality, chance plays a much larger role. Why do we do this? Why are we wired for such misplaced optimism? Part of it is psychological. Our brains crave the dopamine rush of a win, however fleeting. We remember our victories more vividly than our losses, reinforcing the belief that we're better at this than we really are. The media doesn't help. We're bombarded with stories of overnight stock market millionaires and lucky lottery winners. These narratives, while statistically rare, fuel the fantasy that we too can defy the odds. What we don't see are the countless stories of those who lost it all, their dreams crushed by the relentless math of probability. Section 4, Winning a Monet, the blur between gambling and wealth. I once overheard a couple at the Bellagio in Las Vegas discussing their plans for the evening. Tonight, the woman declared, we're going to win a Monet. Their goal? To win enough at the casino to buy a Monet painting. This anecdote perfectly encapsulates the dangerous blurring of lines between gambling and wealth acquisition. The couple's statement, though said in jest, reveals a fundamental misunderstanding about risk and reward. Gambling, by its very nature, is a zero-sum game. For every winner, there must be a loser. Investing, on the other hand, is about participating in long-term economic growth. Confusing the two can lead to disastrous financial decisions. Section 5, The Real Odds. A question of risk and misunderstanding. So, what's the takeaway? It's simple. Understand the odds. Knowing the real probabilities can make all the difference in your decision-making process. Don't let the thrill of the game, whether it's on Wall Street or in a casino, cloud your judgment. The excitement can be intoxicating, but it often leads to poor choices. Ask yourself this: what odds do we misunderstand entirely to our own great detriment? Misjudging these odds can have serious consequences. Are we chasing unrealistic returns, ignoring the very real risks involved? Often we focus on potential gains without considering the likelihood of losses. Recent studies have shown just how pervasive these misunderstandings are. The data reveals that many people consistently misjudge probabilities. Sports bettors, for example, exhibit significant errors in self-control and overconfidence. They often believe they have an edge when they don't. They underestimate the house advantage and overestimate their ability to beat the system. This overconfidence can be costly. This same flawed thinking can lead investors astray, Misunderstanding market risks can result in significant financial losses. By recognizing these psychological pitfalls, we can make more informed decisions with our money, whether we're placing a bet on the Super Bowl or investing in our future. Awareness is the first step to better choices. Remember, the house always has an edge. This principle applies to both gambling and investing. The key is to play the long game, not get caught up in the short-term swings of fortune. Patience and strategy are essential for long-term success.